We appreciate you viewing our channel. Over the past week, the price of Bitcoin has grown significantly, reaching its 9-month high of $27,000 and approaching above $30,000 per coin. The U.S. Federal Reserve's decision to set up an emergency lending facility with a $152.9 billion credit line to support domestic banks was what led to this surge. With this discount window, the central bank will accept underwater securities from struggling banks at market value. In addition, $142.8 billion was allocated to Silicon Valley and the bridge banks of Signature Bank. The quantitative tightening measures implemented by the Fed over the preceding 12 months have been reversed as the Fed's overall balance sheet has expanded by $298 billion. In a recent interview, he discussed the worldwide banking crisis, the Fed's bailout plans, and how they will affect the market for Bitcoin and other cryptocurrencies with Mark Yusko, a well-known investor and hedge fund manager. Yusko believes that Bitcoin and other cryptocurrencies will perform better in the upcoming months than they did in the past during bailouts and periods of economic growth. It's important to remember that this crisis is different from the global financial crisis because the bank's balance sheet lists a variety of different asset kinds. Banks use the public's deposits to fund loans, which could be in the form of mortgages, business loans, investments in bonds or other income-producing assets, or even business loans. In a system that is functioning normally, the assets, shown as green, grow while the liabilities, seen as red, shrink. The gold, which stands for the bank's equity, rises as the green does. If you enjoyed the content, think about subscribing or liking the video. It's free and always possible to change your mind. We value your interest and look forwards to seeing you at the following one. The present banking crisis and its potential impact on the market for cryptocurrencies, such as Bitcoin, are discussed by Mark Yusko. He notes that the variety of assets represented on the bank's balance sheet puts this crisis apart from others, such as the global financial crisis of 2008. Banks collect deposits, lend money, and as long as their investments and loans are successful, their equity or gold rises. However, given the current crisis, the green, the assets, might not be as valuable as they should be, which could cause the bank's equity to drop. Yusko also talks about past crises, such as the Knickerbocker Trust crisis of 1907, in which J.P. Morgan spread false information about the bank, precipitated a bank run, and finally forced the bank into failure. He notes that when certain people stole assets from banks in 1987, it led to a similar situation. Banks extended credit to non-repaying borrowers, which decreased the value of the assets on bank balance sheets and fueled the world financial crisis. In the foreseeable future, Bitcoin and other cryptocurrencies may outperform traditional assets, just as they did in previous economic booms and bailouts, claims Yusko. He ends by urging people to subscribe to this finance content because currently just a small percentage of his audience is a subscriber. The previous week has shown us how fragile the traditional banking system still is and how essential cryptocurrencies are as a way to store money. Recently, Bitcoin hit a 9-month high, and over the previous week, Ethereum also increased by more than 22%. This is hardly surprising in light of recent U.S. Federal Reserve moves, which included the establishment of an emergency loan facility to help national banks. $152.9 billion is the total value of the submerged securities that the central bank will purchase from struggling banks. The move by the Federal Reserve has caused an astounding rise in cryptocurrency markets. In the coming months, we shall expect Bitcoin and other cryptocurrencies to continue to outperform, just as they always have during previous economic expansions and bailouts. Simply put, when people lose faith in the traditional banking system, they turn to alternative assets like Bitcoin and other cryptocurrencies. As these resources are dispersed, No single government or other central organization has control over them. As a result, they become more resistant to the kinds of shocks that could impact traditional financial systems. We may also expect to see a rise in the amount of assets that are tokenized on blockchains in the future years. Everything from equities and bonds to vintage cars and expensive wine will be represented as tokens on public ledgers. This will make it easier for investors to buy and sell these assets, as well as build a diversified portfolio of assets. The past week has shown how vulnerable the traditional banking system is to shocks and how important cryptocurrencies like Bitcoin and Ethereum are as a store of value. In conclusion, it is projected that more assets will be tokenized on blockchains in the future years, making it easier for investors to buy and sell these assets. The future of finance is decentralized and digital, and it already is. It is true that Bitcoin and other cryptocurrencies have historically performed well during periods of economic development and financial bailouts, which is relevant to the cryptocurrency market and Yusko's comments. Regulation adjustments, security breakdowns, and variations in investor sentiment are just a few of the numerous factors that can result in sharp price swings in the notoriously volatile cryptocurrency markets. Also, it's crucial to keep in mind that compared to traditional financial markets, cryptocurrencies marketplaces are still small, and that a small group of influential investors, or whales, who control a substantial share of a particular cryptocurrency can have a big impact on it. This could lead to market distortions like price manipulation. In the end, it is important to exercise caution while investing in cryptocurrencies and to diversify one's portfolio over a variety of different asset classes. Even though cryptocurrency marketplaces offer investors novel and interesting possibilities, it is essential to do your own research and get advice from a respected financial advisor before making any investment decisions. The current dip in the cryptocurrency market, in Yusko's opinion, is merely a short-term setback, and the long-term trend is still rather positive. He points out that despite several boom and bust cycles over the years, the Bitcoin industry has always recovered more powerfully. According to Yusko, the market for cryptocurrencies will probably keep rising as a result of, among other things, growing acceptance by and integration with the traditional banking system. He claims that as institutional investors and mainstream financial organizations become more involved in cryptocurrencies, demand will grow and prices will climb. Yusko is a staunch advocate of using Bitcoin as an inflation hedge and a store of value. According to him, Bitcoin is a superior alternative to gold and has the potential to supplant the dollar as the global reserve currency. Therefore, Yusko urges investors to consider growing their exposure to this asset class and that the current bad market in cryptocurrencies is a buying opportunity. But he does caution that because cryptocurrencies are such a risky and volatile commodity, they should only be considered as a part of a diversified investing strategy. Mark Yusko provides his view on the Bitcoin market in addition to several important forecasts. Beginning on June 15, 2022, he claimed that the market was mostly level with a slight upward bias for about 15 months until entering the crypto spring. He believes that on May 9, 2023, the crypto summer will begin, and the market will see a parabolic run-up that lasts until February 2024, when Bitcoin will be halved. Following each Bitcoin halving event, the market capitalization of the cryptocurrency has typically climbed by 1, and according to Mark, the next fair price for Bitcoin is $100,000. He believes that between Q4 2022 and Q2 2023, we will reach this level. He is aware that a number of factors, such as the introduction of a CBDC in the US and the acts of libertarians and freedom sovereignty supporters, could affect the market, though. As Mark points out, Bitcoin has a finite free float, suggesting that modest changes in demand or small reductions in ownership might both raise or lower the price. He emphasizes that the speed of USDC transactions compared to traditional wire transfers is proof of how swiftly the underlying technology for Bitcoin and other cryptocurrencies is developing. The government would be able to influence and regulate the value of the CBDC, thus he recognizes that there would be a cost. Attempts by the US government to impede the growth of the cryptocurrency industry by restricting access to financial institutions appear to be a source of concern. Some have dubbed this choke point 2.0, since they believe it to be a thorough and well-planned effort to stop the growth of the US digital assets market as a whole. According to hedge fund manager Mark Yusko, the crackdown may not end until 2027 or until regulators accept that digital assets are here to stay. The concept of unbanking or using digital assets like Bitcoin to access financial services is one of the pillars of the cryptocurrency industry. Yet, these measures to limit access to banking services may prevent consumers from using this substitute for traditional banking. There is concern about government actions and how they might affect the Bitcoin market, even though it is uncertain how this will all pan out.